Learn the latest blockchain trends and explore investment opportunities in the crypto market. Welcome to the new world of crypto. Today, we'll discuss a topic that, besides buy and hold, may be the most important and common way to make money in the crypto world. It's not as thrilling as contract trading, nor as elusive as searching for a 100x return coin. It's more like an ancient wisdom collecting rent or earning interest. This practice, specifically called staking in the crypto world, is a term we often refer to as pledging. Staking has evolved from a niche practice a few years ago to the cornerstone supporting hundreds of major blockchain networks, including Ethereum. But do you really understand it? You may have heard that staking ETH can earn a 4% annualized return, but behind the scenes, a world of financial nesting dolls spawned by staking, one layer upon layer of complexity, higher returns, and greater risks, may be far beyond your imagination. Today, based on an in-depth research report, we'll fully and step-by-step deconstruct the crypto world's yield engine, exploring how it has evolved from a simple bank deposit to a complex, layered financial Lego. Let's start with the most basic concept. What is staking? Imagine a blockchain network as a decentralized kingdom. This kingdom requires many people to keep records and ensure that every transaction is authentic and valid. In the ancient kingdom of Bitcoin, PoW, or proof of work, the miners competed in a miner-to-miner system. Whoever had the most computing power and solved the problem the fastest could keep records and receive rewards. This method was secure, but extremely energy-intensive. Staking, also known as the proof-of-stake (POS) mechanism, pioneered a completely new model. This new kingdom declared, "We're done with tournaments. Anyone who wishes to participate in bookkeeping must first deposit a substantial security deposit, also known as your stake, into the treasury." This simple change led to a brilliant design. Honest bookkeeping is rewarded. As long as you work diligently, the kingdom will pay you interest with each entry, which comes from newly issued currency and transaction fees. The cost of malicious activity is extremely high. If you attempt to tamper with the ledger, your substantial security deposit will be confiscated upon discovery. This penalty mechanism is called slashing. See? Staking, at its core, is a mechanism that uses economic incentives to ensure network security. It tightly ties the personal interests of the bookkeeper to the security of the entire kingdom. To attack the kingdom, you must first possess and stake a staggering amount of wealth, making malicious activity highly uneconomical. However, this seemingly perfect fixed deposit model has a significant drawback. Your money is locked up. Because many networks have a deposit period, once your deposit is made, withdrawing it often takes days or even weeks, completely wiping out your liquidity. To address the issue of locked funds, ingenious developers have added a second layer of Lego to this system: liquid staking. How does this innovation work? Let's use the same analogy again. Now, when you deposit your deposit into the treasury no longer just gives you a regular receipt. It gives you a magic certificate, which we call a liquid staking token, LST. For example, in the well-known Lido protocol, if you stake ETH, it will give you STTH. This magic certificate has two amazing features. One, it can be traded at any time. If you need money urgently, you no longer have to wait for a long deposit period. You can sell this certificate on the market and instantly get your funds back. Two, it can be used as new collateral. Even more impressively, this certificate itself represents a high-quality asset that continuously generates interest. You can use it as collateral in other DeFi protocols, such as lending markets, to borrow other assets and make further investments. This brings the whole game to life. Liquidity staking frees up vast amounts of wealth previously frozen in the treasury, allowing it to generate safe returns while continuing to create value in the broader DeFi world. According to reports, by the end of 2024, the total value locked in global liquidity staking will reach $58.9 billion, with Lido alone accounting for half of that market. If you think liquidity staking is impressive, then this third layer of Lego will further challenge your understanding. It's the hottest concept right now, res-taking. The originator of this concept is a project called EigenLayer. Its founders came up with a truly bizarre idea. Let's continue with the kingdom metaphor. Your deposit is now safely and securely stored in the treasury of Ethereum, the main kingdom, providing it with security. At this time, many emerging small kingdoms, such as Oracle networks and data availability layers, also wanted to develop, but they lacked the financial resources to build their own robust treasuries and security systems. Eigenlayer stepped in and said, "Fellow account keepers of the main kingdom, your deposits in the treasury are just sitting there doing nothing. How about this? You authorize me to recollateralize the reputation of your deposits, while also providing security for us small kingdoms. In return, we small kingdoms will pay you an additional fee." This is the essence of res-taking, leveraging a single staked asset to simultaneously provide security for multiple networks and earn multiple rewards. For example, suppose user Alice has 1 ETH. She first stakes this ETH on the Ethereum network, obtaining SDTH representing her staked equity and continuing to receive Ethereum staking rewards. This is equivalent to Alice owning an asset certificate. Alice then restakes this SDTH on the Eigenlayer protocol. Eigenlayer uses Alice's SDTH as additional collateral to provide security for other blockchain networks, cross-chain bridges, or decentralized applications, such as sidechain rollups or bridge services. In other words, Alice's ETH first provides security for the Ethereum mainchain, earning staking rewards. Simultaneously, Alice restakes the converted SDTH on Eigenlayer to help secure other applications and generate additional returns from these applications. This is like catching multiple fish from the same coin, allowing capital to eat multiple fish. Throughout this process, Alice's ETH provides security for multiple networks through a two-layer mechanism of original staking and restaking. Not only does she receive staking rewards from Ethereum itself, she also receives multiple benefits from other protocols supported by Eigenlayer. Through this mechanism, the same asset can be leveraged across multiple networks, allowing users to continue to receive rewards from the native staking network while also earning additional staking rewards from multiple additional networks. Take the Eigenlayer protocol, for example. It allows Ethereum stackers to restake their staked ETH or LST tokens in other protocols requiring security, thereby reaping multiple benefits, a phenomenon known as killing two birds with one stone. This greatly improves capital efficiency. New projects no longer need to start from scratch and attract billions of dollars in funding to launch their own security networks. Instead, they can simply rent Ethereum's existing Great Wall of Security, built on tens of billions of dollars. According to a report, by the end of 2024, the total locked value in the res-taking sector will reach $24.7 billion, with Eigenlayer alone accounting for 62% of the market share. However, this ingenious design also introduces a fatal risk, which the report calls contagion risk. Because you use the same security deposit to work for multiple employers simultaneously, if you make a mistake in any of your smaller kingdoms and have your security deposit forfeited, your total security deposit in the main kingdom will also be reduced. A security breach in one small kingdom could trigger a chain reaction, weakening the foundations of all other kingdoms that share the security. It's like a fire in a small tenant building, but because the firefighting system is shared, it could ultimately threaten the safety of the entire building. Do you think that's the end of it? No, above these three layers, the market has built a fourth, and by far the most complex, layer, liquid res-taking. Simply put, after you complete the one deposit, two jobs res-taking operation, another protocol reissues a magic certificate for your res-taking, which we call the liquidity res-taking token, LRT. This financial nesting doll has now reached its fourth layer. Each layer releases liquidity and increases potential returns, but also amplifies the underlying risks. So, what does all this mean for us investors? First, you must clearly understand that staking is no longer a simple, interest-earning game. It has evolved into a complex financial derivatives market. Those temptingly high returns you see often hide layers of protocol risk, smart contract risk, and the contagion risk we mentioned earlier. Secondly, the Matthew effect in this market is highly pronounced. The report's data shows that whether it's Lido in the liquidity staking sector, Eigenlayer in the restaking sector, or Ether.fi in the liquidity restaking sector, each one dominates. While this brings efficiency, it also introduces new centralization and systemic risks. If a leading protocol encounters problems, the entire sector faces catastrophic consequences. Looking ahead, the report mentions a potential catalyst that could ignite the entire staking market, an Ethereum spot ETF. Currently, these US-listed ETFs, holding vast amounts of ETH, are prohibited from staking. But imagine what would happen if regulations were relaxed in the future, allowing these Wall Street giants to invest their billions of dollars worth of ETH in the yield engine we've described today. This will not only bring an unprecedented amount of capital to the staking sector, but also means that in the future, if you buy an Ethereum ETF, you may automatically become a passive rent collector. The world of staking is like a giant Lego castle. It begins with the simplest deposit brick and builds upwards, layer by layer, becoming increasingly grand, more sophisticated, and more dangerous. As an investor, before you get lured in by those tempting yields, you must first ask yourself, how many layers do I understand? How many layers of risk am I willing to take? Do you simply want to stay safely on the first layer, earning the most basic but reliable deposit interest? Or are you willing to climb up, pursuing higher returns, but exposing yourself to higher and more complex risks? There's no single answer to this question. But only by understanding these layers of matryoshka structure can you make the most sober and appropriate choices in this crypto world's rent collection game. The above content is for information sharing only, not investment advice. Thank you for your attention.